Right now, shares of Archer Aviation, ticker ACHR, are trading live at $8.18. And it is a rough session for shareholders, with the stock plunging 8.66% so far today. This continues a brutal sell-off we've seen over the last few trading days, pushing the stock down dramatically from its recent highs. And looking at that move, the immediate gut-level reaction is that something must be fundamentally broken. The expectation, seeing a pre-revenue tech company fall this hard, is that the story is collapsing, that the cash is running out, or that a competitor has just left them in the dust. But what if the reality of this exact moment is the complete opposite? What if this sell-off isn't a signal of failure, but rather a massive, misunderstood reaction to the company aggressively securing its long-term future? That is the profound disconnect we are seeing in ACHR stock right now, where the market is focusing on one line item from an earnings report while seemingly ignoring the multi-billion-dollar strategic chess moves announced in the very same press release. Let's establish the common ground, because the bearish case writes itself, and it's what many traders on platforms like Robinhood or SoFi are likely reacting to. Archer just reported its third quarter 2025 results. The headline number? A wider-than-expected net loss of nearly $130 million. For a company that isn't generating commercial revenue yet, any loss that's bigger than analysts penciled in is going to trigger warning bells. This is the expectation. High-growth, speculative tech like Archer or even its competitor Joby is all about cash burn. The market's biggest fear is that the company will run out of fuel before the plane ever gets off the ground. So when they see that loss, they sell. They see the concurrent announcement of a $650 million capital raise, and they don't see a war chest. They see dilution. They see their slice of the pie getting smaller, and they hit the sell button on their Fidelity mobile app or their Interactive Brokers platform. This is the narrative, and it's driving the price action we see today. The stock is down, and the expectation is that the dream is fading. But here is the reality, and it's where this story gets far more complex and, frankly, far more interesting for anyone doing serious online investing. The market seems to have read the first paragraph of the Q3 report and skipped the rest. Yes, the loss was wide, but in the same announcement, Archer just solved its single biggest existential risk: funding. That $650 million equity raise isn't a desperate gasp for air, it was a strategic move that brought their total liquidity, their cash on hand, to over $2 billion. Let me repeat that. $2 billion. For a company of this size, that is a fortress balance sheet. It effectively funds them through all their certification goals, through their manufacturing scale-up, and well into their planned commercial launch. While the market is selling off over a quarterly loss, Archer just ensured it has the endurance to finish the marathon. This isn't just a small detail. It fundamentally changes the risk profile of the investment. And that wasn't even the biggest news. On the same day, Archer announced it has signed definitive agreements to acquire control of Hawthorne Airport in Los Angeles for $126 million. This isn't some minor land deal. This is a massive, strategic physical asset. This is Archer buying its own operational hub in one of the world's most congested and important target markets. They are positioning this as their base for the LA 2028 Olympics, a test bed for their AI-powered air traffic management, and the core of their Southern California network. This is a move that screams long-term vision. They are not just building an aircraft, they are buying the infrastructure to operate it. This is a vertical integration play that most analysts hadn't even factored in. They are building a moat, and they used their strong stock price from earlier in the year to raise the capital to do it. And there's more. The company also announced it closed the acquisition of Lilium's patent portfolio, adding over 300 patents to its own. This bolsters their intellectual property, gives them access to next-generation technology in areas like ducted fans and electric engines, and solidifies their position as an industry leader in terms of technology. So let's recap the reality that the market is selling off on. A wider-than-expected loss, paired with securing over $2 billion in liquidity, buying a major LA area airport, and acquiring a significant competitor's patent portfolio. This is the tension in ACHR stock right now. The expectation is set by the short-term loss. The reality is defined by overwhelming long-term strategic execution. So who is right? The traders selling on the intraday chart or the long-term holders? Well, let's look at who's been buying. The F-13 filings, which show what large institutions are doing, are telling. The two largest holders of ACHR are not hedge funds, they are Vanguard and BlackRock. These are the biggest investment managers in the world. And recent filings show that in the third quarter, Vanguard massively increased its position, buying another 16.45 million shares. But even more telling is the smart money trade. Cathie Wood's ARK Invest, famous for its self-investing thematic funds focused on disruptive tech, the same firm that made legendary calls on Tesla stock, waited for this exact sell-off. The moment the stock tumbled on the earnings news, ARK stepped in and bought over 3 million shares. This is a buy-the-dip move from one of the most watched growth investors on the planet. While the retail crowd on Robinhood might be panicking, ARK, which operates on a multi-year time horizon, sees this as an opportunity. They are looking at the $2 billion in cash and the new airport, not the quarterly EPS figure. This is the kind of analysis we try to provide, looking past the noise of the daily swings. It's easy to get shaken out of a position, whether it's an Apple stock or a speculative name like Archer. That's why many people look to investment help or services like Schwab Intelligent Portfolios to automate decisions and remove the emotion. But for those managing their own individual broker's account, this is a classic case study. The daily volume on ACHR is massive, with over 69 million shares changing hands today, close to its average. This indicates a high-conviction battle. The bears are selling hard on the losses and the dilution. The bulls, including major institutions, are absorbing those shares, betting on the long-term operational milestones. And those operational milestones are progressing. Archer's Midnight aircraft just completed its longest flight to date, 55 miles. It hit an altitude of 10,000 feet. It's flying demonstration flights in Abu Dhabi and in California. This isn't a computer rendering, it's a real aircraft hitting real test flight targets. The company is guiding for commercial operations in the UAE by the third quarter of 2026 and is obviously all in on the LA 2028 Olympics. The entire eVTOL sector, of course, is a high-stakes race. You have competitors like Joby, which is also making incredible progress on its own FAA certification. You have international players. This is not an investment for the faint of heart. This is a pre-revenue company in a brand-new capital-intensive industry. A single regulatory setback from the FAA could delay timelines by years. A manufacturing problem could be catastrophic. These are the real risks. You aren't just betting on Archer, you're betting on the entire urban air mobility concept, and you're betting that Archer will be one of the few winners. But the analyst community, for the most part, remains firmly in the bull camp. Despite the volatility, the consensus rating on Wall Street is a strong buy. The average price target is sitting around $1,250 to $1,300. Even the analysts who've adjusted their models post-earnings like JP Morgan still have a target of $8, which is right around where the stock is trading. The more bullish firms like H.C. Wainwright have an $18 target, suggesting more than 100% upside from here. They are all running models based on future revenue streams that don't exist yet, which is why this is so volatile. They are trying to put a price on a future that Archer is actively building, or as we saw last week, buying. What we're seeing today is a textbook example of market short-termism. The market is acting like a nervous passenger, flinching at every bit of turbulence. But the company itself is acting like a focused pilot, executing a complex flight plan. The $2 billion in cash means they have the fuel for the whole trip. The Hawthorne Airport acquisition means they've secured a prime landing spot. The patent acquisition just upgraded their navigation systems. The core company has arguably never been stronger or better capitalized than it is today at the exact same moment its stock is hitting a multi-week low. This is the paradox of Archer Aviation right now. I want to know what you think because this is where the market is made. Comment below with your take. Is this 8% drop today a justified reaction to the cash burn, or is it the single best buying opportunity of the quarter? Let me know. Looking forward, the path for Archer is clear, but it is not easy. The next 12 to 18 months are all about certification. Every press release about FAA milestones will be scrutinized. Any delay will be punished. Any acceleration will be rewarded. The company will be spending hundreds of millions of dollars before it makes its first dollar from a passenger flight. That is the reality. This isn't a stock you check day to day, it's when you check quarter to quarter, milestone to milestone. Many investors may be